Excited to have Dominique Mielle, thank you, who will be discussing the distress cycle, the sector's lack of diversity, and potential opportunities for investors in distressed investments in the year ahead with the Roundtable's very own Mr. Marc Schneider. I want to thank you for doing this. Dominique is a Franco-American investor and author of Damsel in Distress, which a lot of you should have received her book tonight from the Roundtable. It's a hedge fund memoir penned by a woman, the first one, right? Is that right? Okay. And prior to writing about her experiences with distressed investing, she was a partner and senior portfolio manager at Canyon Partners, where she oversaw the management of $2.5 billion of investments in stressed and distressed investments, corporate securitizations, and developed and led the firm's collateralized loan obligations business. Marc Schneider is the founder of 12 Lines Capital, a financial advisory consulting and investment management firm. Prior to founding 12 Lines, he was a managing director at Avenue Capital Group, where he was responsible for the firm's European funds investments in basic material sectors. And he's a long-standing member of the Roundtable's Management Committee. So without further ado, I will turn things over to Marc. Marc, thank you, and Dominique, thanks a lot for doing this.
Thank you, Kunjan. Appreciate you all coming today. Thank you, Dominique, for joining us today. I've read the book. I highly recommend the book to everybody, and I think we're going to have some good things to talk about. So what I think might be helpful for people to get a sense of your background, and why don't you tell us a little bit about how and why you became a distressed investor?
Sure. Well, my path has a lot to do with luck, which I don't think is something that most hedge fund managers discuss or disclose. Usually the story is about how they received a calling early on to trade and sort of, started trading lemonade and lemons when they were in high school. This was not the case. I was born and raised in Paris. What I wanted to do with my life, I had no idea, whatsoever. I just knew I wanted to leave and sort of see the world. So I got a job in New York as a commercial banker, which I quickly discovered was sort of the lower caste of Wall Street. I moved on to investment banking, which I quickly realized was not for me. I hated that job with a passion. And then I went and got an MBA at Stanford, which is really where I started being interested in being on the buy side, meaning investing for a fund. There were a couple of classes that I took that were sort of really critical in my interest developing for particularly credit, but investing in general. And then in '98, when everybody in my class went into what was called the World Wide Net, and that was a time when, if you had a website, you had to say www dot. I was sort of the lone loser going into finance still, and all my friends were really baffled that I would choose to bury myself in a sector that clearly had no future when they were going on to great adventures developing websites. And I joined a little firm, sort of a scrappy little hedge funds. All hedge funds were pretty small at that time, called Canyon Capital. We were half a dozen people. We had 500 million assets. It was '98. I joined the day Russia defaulted on their bonds and the market crashed, and I thought, this is great. This is going to be a great adventure. Let's do it. Maybe I can make an impact here.
Was there something about distress that attracted you to that fund, or was it just?
A little bit. I had read books about Michael Milken, and I thought, well, that seems like an interesting market. And it seemed like it was not only about choosing companies and looking at businesses, but it seemed like it was a very strategic job where you had to position yourself in the capital structure, know what all the other layers of the capital structure would do, and sort of try to get the biggest piece of the pie. And that seemed different from just buying a stock.
Right. So is that why, this was a quote that I loved in the book, You say, for one thing, whereas a stock is not a particularly interesting security, junk bonds are fascinating creations. Is it because of that various structurings that you say that?
It's for a couple of reasons. I think a stock is a piece of equity. Per se, it's not a particularly interesting or sophisticated financial instrument. It has maybe a dividend, maybe it has voting rights, but that's about the only variation you find. Whereas a bond is a private piece of debt between a corporation and an investor, and as such, it can have thousands of different terms. Obviously, the maturity, the interest rate, the covenants, the security, the collateral, call protection, everything, and all these things change with the market, and all these things, even the smallest one, can make the difference between a losing trade and a winning trade. That seemed really interesting to me. That's sort of on the fixed income side in general. Particularly on distressed, you'll have a company that is either in bankruptcy or on the verge of bankruptcy. There's a finite asset size, and all the participants in the capital structure, from the loan to the bonds, the vendors, sometimes the pension plan, sometimes the equity, they will try to restructure the company and get as much value from the asset as they can. And in that respect, being a distressed investor is very much like playing chess. Like, there's a board, you look at who is positioned how. It's very much Game of Thrones. And you're the, what is she called? The Queen of Dragons? Whatever her name is.
Mother of Dragons.
Mother of Dragons. That's a Freudian slip right there.
So I guess it requires a slightly different skill set to be a distressed investor than, say, long short equity to some degree.
I think long short equity investors are very much interested in businesses. I have to confess I'm less interested in businesses and more interested in the strategic interplay of the layers of the capital structure, the legal terms of all the pieces of the capital structure, the negotiation between stakeholders. That's what for me was the thrill and the fun of the job, more so than whatever the company was making or doing.
So you started Canyon in the late 90s, and you worked in what you call the golden era of distressed. And the first, I guess, 10 years you were there, distressed and other, alternative asset classes outperformed the market. What were the conditions in the market that really allowed managers of alternative assets to outperform?
I mean, I'm sure most hedge funds would not say that, but to me, it was supply and demand. You had several crises. The one in particular was 2001 telecom crisis, which the media sort of described it as a dot-com bubble crisis, but it was the bubble burst on dot-com companies, but those were not levered, so that was not particularly interesting to me. But the telecom crisis was huge, and we're talking about wireless, wireline, cable companies, and those were highly, highly levered companies. So there was an enormous amount of distressed assets. And in addition to that, this was before SOX and regulations of financial statements, so you had a lot of companies, a lot of corporate malfeasance and fraud. If you think of Enron, if you think of WorldCom, Conseco, Tyco, and all these were, 80, 100, or 100 billion plus companies in bankruptcy or in distress. That's the supply. That was the supply. And versus a hedge fund business in general that was quite small, and a distressed community that was even smaller. So we were a few people, a small number of hedge funds, looking at an enormous supply of distressed assets. So in a way, we had just the choice of different picks, and you had really very good deals because there were few buyers and lots of sellers. And that situation has reversed pretty dramatically since '08.
I think you mentioned in the book that there were 16 times, the amount of distressed debt was 16 times the assets allocated towards buying it. So it really was a buyer's market.
It was. There was all the choice. You'd wake up and have more stuff to look at.
One of the trades you discuss in the book, and I like this story, was the WorldCom trade. And your son refers to it as the WorldCon trade, right? So
Yeah, because he asked me one time, "Have you ever lost money?" And I said, "Yeah, of course I have."
Yeah.
So he was not impressed with that response. So he asked me, "Well, what was one of the case?" So I described WorldCom and trying to make myself look good. And he said, "Well, should have known with a name like WorldCon that you were gonna get." That was his positive attitude towards my career.
But while you initially lost money in the trade, you ultimately made
Yes.
quite a bit because you were able to buy the bonds much cheaper subsequently. Is that a typical, do you have a lot of opportunities in the distressed universe to reinvest in companies in that way?
I mean, as you've been in the business, the goal is not to lose money first and make money after. That it would be nicer to just make money. But it does happen quite a bit that your entry trade is not at the optimal level and that things get worse from the moment you've bought. So it sort of triggers a whole a second wave of analysis of the position as things get worse and prices go down. But it requires quite a bit of stomach fortitude to buy more when you've lost money. And of course, you're not investing on your own, right? This is not the Harvard Investment Club where you have a fictitious portfolio and fake money and you're the only one making decisions. You have bosses, unfortunately, and partners, and you have to convince them that your initial mistake was great and you should be buying more. It's a tough conversation.
Right, and there must be some dissidence that the bonds went from 90 cents where you bought it down to 20 cents, I think you said in the book, and you must be saying, am I throwing good money after bad? And how do you remain objective? Because the goal of the investor is to be objective and evaluate every situation anew.
Right.
How do you deal with that stress and that dissidence?
Poorly. Very poorly, at least back then, because that was one of my first trades. So when you lose that much money in the space of a moment, because those bonds I bought at very high levels, and the company was supposed to pay me back a few months later, and literally in the space of an hour, a press release went out that the SEC was investigating the company for fraud, and those bonds dropped from 96 to 20 just like this. So I thought I would also drop like this in that same instant. And in that particular case, being a young analyst, I just wanted to call my mom. that was my reaction. I didn't know what to do. But the partners obviously had a lot more experience, and they guided me towards, all right, there's the new a price point is always a new situation, right? It's basically the start of every day, every hour of your portfolio. Do I have enough? Do I have too much? Am I properly valuing those bonds? So they sort of guided me and walked me through what is essentially the job. Once the bonds are at 20, is that a good buy? Because clearly 96 was not. Yeah. And at 20, we sort of re-engineered the entire analysis and thought it's a very good buy, particularly because different bonds were trading at different levels. You could swap at the time there were two companies, MCI, WorldCom, there were different businesses, different assets. So it was a very steep learning curve. Right. That somebody with more experience than me could walk me through.
Well, valuable lessons learned though at that time.
Always. Yeah. Although you prefer it, and the job of trading is in general, I think, a great life lesson because you lose all the time. right? I mean, I think the myth of great investors always having winning trades is just that. It's just a myth. I think what matters is winning more on average than you lose, but you're wrong every day. And you just have to accept that failure is just the flip side of a winning trade, right? So that's a pretty nice lesson in life to have that. Not particularly pleasant at times, but sort of you learn to accept your losses as part of the business.
Absolutely. So then talking about losses, so
Can we talk? Are you my son? You talking my son?
No, I want to talk about a tough time in the industry, the years of the global financial crisis. We'll fast forward to that, because describe what trading was like in that environment.
It was awful mostly because there was none. It was one thing to be trading in stocks with the market crashing and being at levels that you hadn't seen before, but at least you could transact in stocks, right? You could buy and sell or have price points. But in our markets, the trading virtually disappeared for months. So you might have a good idea to buy something and sell out of something worse, but that order never got filled, as we say, because there virtually was no two-way trading at that point, and that went on for a very long time.
Right.
So it was completely paralyzing.
But fortune favored the brave, the people that were able to make trades did well at coming out of that.
You know, I feel like, yes, partly it's true that the brave were shown great rewards, but it's also the guys who simply could hold on and who didn't have to sell. That's sort of the greatest conclusion that I had was, if you held on to your assets, a lot of the assets came back. But the trick was to have the structure and the investors and the platform solid enough to make it until then.
Right.
And a lot of hedge funds didn't.
Yeah. Well, it's interesting because if the job of a distressed person is to some degree taking advantage of illiquidity for the companies, they can be caught in that same trap of dying.
Oh, for sure.
So having locked up capital is an important thing.
You know, and that idea of having locked up capital and really rethinking what your assets are and what your liabilities are. So how you're raising money, how investors can or cannot take money out, and how liquid or illiquid, well-marked or difficult to mark your assets are. That sort of came out of 08, right? Before that, we were all, with the same structure of evergreen hedge funds and thinking we have plenty of money, we can face any redemption. And that changed dramatically with 08. And not only that, but it turned out that you need to be a large hedge fund to survive. You need scale, you need size, you need different products, you need very stable structures. All that was sort of not well explored before 08, and we went from having an industry that was pretty immature, growing very exponentially, to having an industry that really bulked up, and hedge fund managers becoming captains of industry, trying to diversify and get to a more mature point.
Right. And that brings us to the next period from financial crisis to, let's say, 2020 to to last year. And at this period of time, distressed and alternative asset managers underperformed. You talked about one of the factors there, the growth of funds, but maybe you can talk a little bit about why that underperformance happened after so many years of overperformance.
There are a few things. So one, as we said, is the supply balance totally changed, right? So hedge funds, and distressed in particular, but all hedge funds became very, very large, and distressed assets were not particularly abundant in that year. And the distress cycles were not particularly deep or big, mostly because of the Fed. right? So the Fed in many ways stole, the Grinch who stole distress, because they provided a lot of liquidity. And so if you think about the biggest sort of bankruptcy cycle, distress cycle that we've had lately was 2020 with COVID. Well, the biggest bankruptcy case was Hertz, and Hertz was only 25 billion in assets. So if you compare that to a distressed fund like Oaktree, which is one of the largest distressed investor, in that year they raised a fund of 15 billion, right? So just them alone could almost buy the biggest distressed case. So compare that, so the biggest big bankruptcy was Hertz at 25, the second was Latam at 20 billion. Compare that to 2008, where you had Lehman Brothers at 600 billion. Compare that to Wellcome of 100 billion, right? So literally, distress became a shallow, small phenomenon because the Fed has been there to be the buyer of last resort and sort of stealing that market away while hedge funds were getting bigger and bigger.
Right. So you have the flip of what you had in the earlier period. You went through a period of huge
Abundance,
amount of
right.
supply, not many people doing it, to everybody doing it, and the funds being larger and no supply because
Yeah.
of the Fed.
Yeah.
But things have changed dramatically in the past 12 months. The Fed seems to be getting out of the market. We have inflation. Volatility is back. We haven't seen volatility in the rates or spreads for years. It's been a one-way street for years.
Right.
So the question is the time right for another golden age now that the Fed is getting out and there's going to be more
Yeah,
defaults?
I mean, for sure, I think it's probably the most interesting time to be a distressed investor. And I wouldn't have said that a year ago.
Right.
But there are necessarily more distress coming, I would think, with higher interest rate, higher inflation. One would think, and the Fed disappearing, or at least not employing QE in the next few years. So it is interesting. That doesn't. The fact remains that funds are very, very large. So we're going to need a huge influx of distress to go back to the levels of double-digit returns we had back in 2001 and 2008. But at least if you call distressed any bond that trades over 1,000 above treasuries, when treasuries are 1%, it's barely double-digit. If it's 5, now you're making 15%. That's something.
Right.
That's something.
Absolutely. So, I guess, how do because you talk about two factors. So there's going to be more supply of distressed assets. I think that's most people feel that way. But you have bigger funds investing. So you mentioned the Warren Buffett bet. For those that don't know, in 2008, Buffett made a bet that 10 hedge funds, he had a bucket of I think 10 hedge funds would not outperform the S&P over the next 10 years. And for some of the reasons we just talked about, Buffett won that bet. If you were to make that bet right now for distressed investors, which side of that would you take?
I have to say I'd take the Buffett side again. And one of the reasons Warren Buffett made the bet, or the reason he made the bet, and the reason he says he won the bet, is not because he thinks hedge funds are not good, but it's because they charge so much. That they charge so much fees that on a net basis, it's very hard to beat a manager who charges very little fees. And that is still, we still have the same issues. The big difference again is rates are higher, and so presumably if you buy fixed income bonds, you have a bigger potential return from which you take out fees. But I would make the same bet because probably for different reasons, it seems to me that it's getting much harder to be a distressed investor. There are very large funds that it's very hard to differentiate yourself from one another. By and large, I think the portfolio of big investors those portfolios are very similar.
Right.
And the correlation between assets has risen as well. So, typically in the last at least 15 years, distressed and stocks have gone pretty much the same way.
Right. But with more volatility in the market, which we're now seeing, I mean, that is the environment that fundamental active asset managers say they thrive in.
For sure. And again, if there was any time to be an active manager and a distressed investor, I think it would be now. And that's even without counting the cryptocalypse and all those companies that didn't exist before coming to the distressed and the bankruptcy environment.
One of the things I think, if you've not been in this business for more than 12 years, you've never seen anything but a one-way market. You've never seen, as you described, the financial crisis where there's no bids in the market.
Right.
And they've been in basically a manipulated market. Do young professionals who've only seen that side of the business, have they learned to properly price risk in an unregulated market or a free market?
Well, I think people who have not been in the market for more than 10 years definitely don't know what high interest rates are. And that has implication for just about everything from labor to supply to, and anything the company does. But, that's not, there's high interest rate, there's also inflation. And I was at a conference 2 months ago of 200 people. Not one investor had invested in an inflationary environment for the good reason that it hasn't happened since the late 70s, and there are few of us who were there. And again, that has repercussions for just a ton of things. So it's not just that the Fed was providing a support to bonds, it's also that we're doing business in a very different environment that most investors today, and particularly the young analysts, have not seen. But that's really interesting and fun.
Yeah. You've also, I've read some stuff where you've talked about, you think the next cycle, the stress cycle, is going to be different, and stakeholders are going to be slightly different. You're going to have more input by vendors and retail investors and unions. Is that correct? Did you say that?
I did say that, and there are a few things in the upcoming distress cycle that may be different. At least there are a few factors that I see different. Labor is one. I think we have in this country a growing labor movement. We are seeing more unionization in big companies, from Trader Joe's to Starbucks, and it's still small, but it's definitely more so than in any past year over the last 15 years. And that's something that's that as a distressed investor in a bankruptcy, I've rarely had to think of how do I keep my employees? What's the turnover of this company? How do I pay them? And I think that's going to be a factor in the coming bankruptcies. The second is something that emerged during COVID, which is the rise of those retail investors through a bunch of platforms, including Robinhood. And they were sort of treated as ignorant punks in the beginning, right? And only stocks and meme stocks, but it's not just those stocks. They've had lasting impact on real companies and permanent changes, permanent impact on those companies, like Hertz, right? Which ended up giving value to equity in bankruptcy. And for those who've been in the business before, it's extremely rare that the existing equity of a company in bankruptcy keeps value. And they can be the difference between bankruptcy for Hertz or not. Like AMC was able to avoid bankruptcy because of those retail investors, and they have something that none of the institutional investors have, which is the ability to cooperate. For us, it would be called colluding. We can't do that. but they are able to sort of form an army and go in one direction and take a hedge fund to its knees.
Right. So you retired in 2017, 18?
18.
18. Any desire now that the cycle's turning to head back into distressed investing?
No.
Enjoying life too much.
That is exactly right.
I want to turn to diversity, but before I do, I want to see if there's any questions from the audience. Here?
Yeah, I'm curious about, you mentioned AMC at the end here, this new thing I've been kind of reading about these apes, or whatever they're called, which sound incredibly complex way of diluting the hell out of all those sort of simple common shareholders. Do you think of that activity, and should that be allowed or controlled in some way, that kind of effort?
I don't really allowed. I mean, it is
legitimate.
there are financial securities and financial innovation happens all the time, right? So there are interesting developments, but they don't seem to be very beneficial to holders at the end of the day. Their value is sort of questionable.
So dissecting them particularly isn't a way one could find a way to play the distressed world better. It's a one-time thing, so you're not going to see this every day, I suppose.
I think this was kind of a one-time thing. What it does do is inject a lot of volatility at the bottom of the capital structure. So, right, so if you think of distressed investors in bankruptcy or even outside of bankruptcy trying to think of a plan, a new plan for a capital structure where all the stakeholders have to approve, it makes it very difficult if the bottom of the capital structure from one day to the next has zero value and 300 million of value and can object to a plan. That is really hard, and that's exactly what happened in Hertz. They went through, I think it was 3 different restructuring plans before finally giving value to the equity. But that's a tough gig to have a completely changing capital structure and a company coming up with financial securities that are dilutive, but also sort of bizarro in their construct.
Please introduce yourself, sir.
So, Rob Cohen at AIC Group. Are you surprised that there isn't as much cross-fertilization between activism and distress? It seems like Elliott seems a little bit more active in that area. It just hasn't done too much.
I think there is quite a bit. I mean, maybe not activism on the left side of the balance sheet and not as publicly, meaning distressed investors are probably not going to be the ones writing letters to a company saying you should really sell this piece of this sector of your business or buy or merge with something else. But they're very active in the capital structure. That is exactly what they do, right? Working with the company, but that's the whole job. They're activists on the right-hand side of the balance sheet with the capital structure. And of course, we do try to improve the business. Well, if it's a retail company, maybe close the stores that are unprofitable, shut down some business, improve the vendors' terms, tons of improvement that are more gradual and less sort of sensational than the activists that you're thinking about, the Damsel and Ackman, etc.
Is part of it because of the structure of the trustees and the court system with respect to when there's filings versus in activism, it's more the company and the investor with its board.
Yeah, if you think about it, activism, when you're a stockholder, the only way you have to impose changes is to write a letter and convince the board, right? That's all you can do. As a creditor in bankruptcy, you are probably going to own the company, and so you can really impose the changes to the capital structure by according to the bankruptcy code,
And you have a contract with the company as a
and you have a
creditor.
contract.
Yes.
Hi, Andrew Elson. Actually, I have two questions. Let's see if I can get both in. One, I wanted to get your opinion, Dominique, about the market has gone very covenant light over the last decade or 15 years. I'd love to get your view on that. And second, SPACs had their 15 minutes of fame, and a lot of those companies are now trading at 10% of what they went public at. I'd love to get your view on that also.
I mean, I'll take the SPAC first. As you said, that was financial innovation that sort of was kind of illogical. It had some benefit because if it was sort of an arbitrage between doing an IPO and doing a SPAC, but really that's sort of the only advantage. If it's cheaper to go with a SPAC than do an IPO, then it makes sense. But in all other occasions, then you're making the SPAC holders very rich. And I'm on the board of a SPAC, so I mean, God bless them. But I think the ship has sailed, and that poor SPAC is going to expire without an acquisition. But it was an instrument that had its logic in very few cases, that suddenly was sort of touted as the end-all be-all of all private companies. And I personally was interviewed to be a board member of a few of those VC-backed companies where literally they had no audited financials, they had no treasurer, they had literally 10, 20 million of revenue, and they were going to become public at billion-dollar valuations in the next 3 months. And they would ask me, do you have any interest in being on the audit committee? And I thought, probably not, because that just doesn't seem quite right. But this was the state of craziness, that you had companies that with virtually no revenue, definitely no profit, and no structure whatsoever to become public companies, that were becoming and did become public companies. And so you can imagine a public company usually has public investors who ask questions, and some analysts might ask questions, and you might want to provide some forecast, and you might want to close your books on time, and have your auditor sign off on your financials. All these things were not in place for a lot of those companies. So that I think SPAC in itself is a structure that is valid, but not to the extent that it was used. That was clearly a folly. What was your other question?
Company.
Oh, covenant light. Actually, if you look at the studies, there is no correlation, at least last time I looked, there's no real correlation between between a lower recovery rate and a lack of covenant. So it's not clear that if you don't have a covenant, you're gonna go bankrupt faster and recover less as a creditor. Almost to the contrary, if you have no covenant, meaning you have no financial hurdles to stay in compliance with, you're gonna be out of bankruptcy longer. So it really, I can see both sides, but I have yet to see a study that says, lack of covenant is really bad for lenders. Have you seen anything like
No.
this? We've talked about it for decades, because that's been going on for years. And the other thing you see is typically in good markets, the good companies are quick to get rid of their covenants. But these are companies that you want to lend to. And the bad companies keep covenants to attract investors, but these companies are the most risky. So there's sort of a negative selection that is, the answer is not quite clear there, what if there are clear consequences of covenant-light loans.
But I would imagine that on the leverage off that in the next cycle, investors are gonna wanna pay a little bit less for covenant-light loans than historically they paid, because it lowers their control, therefore they're gonna
Yeah, but
theoretically.
that's true of every cycle. The market gets tight, covenants are put back in place, tighter baskets are smaller, collateral is bigger, leverage point is lower. So that's why the corporate bond market is so fascinating, is because there's constantly a shifting between investors and issuers, and there are subtle changes in those terms.
Yes.
Are you surprised by the number of bankruptcies or lack of that have occurred given the 450 basis point rise in interest rates? A few years ago, we would have said if rates went up almost 5%, a wall of refinancing would have defaulted. Are you surprised it hasn't happened? And if
I
you
am
are,
a little
how are
bit-
people absorbing these high interest rates?
Remember that a lot of that has been refinanced in 2020 when rates were still low. So I think corporations have really seized the opportunity to shore their balance sheet as liquidity was still plentiful. Credit investors came back massively to the market when after the initial crash. So a lot of companies have really taken care of their balance sheet, but I think it's still to come. I would imagine that default rates are going to go up because you're right, 5% is a big hurdle. So I don't think we've seen there's a lag between rates going up and companies defaulting, because I think they've been in a pretty good position to refinance in the last 2 years.
What do you think the catalyst will be going for that wave to start coming? Is it gonna be downgrades by the rating agencies? Is it gonna be a recession?
I'm not sure there's a catalyst. I think it might be just a gradual increase in default rates in sectors that are having a tough time refinancing.
Right. And I suspect companies that have floating rate loans are a lot worse case than borrowers that have fixed rate loans for the next 5 years.
We'll see.
Yeah. Any other questions?
Just to comment on that, the only thing is it's unusual to have rising rates and the economy is so strong. So that's why between them having raised a lot of money before and the economy is still strong, we're not seeing the distress cycle yet.
Presumably,
We're at this level,
yeah.
it will happen.
But as a distressed investor, you're always predicting that distress is right around the corner.
The gentleman there.
Bill Gordon, going forward here, if you're sitting and you've seen the gradual growth, I guess, through Canyon, if you're facing another default, another opportunity for distress, with 50 billion or 30 billion versus 500 million to $1 billion, where would you rather be and why?
As an investor, or meaning as a limited partner, or as a manager?
Well, kind of both. I mean, the ability to outperform or having too much money. You spoke in part of your book about having too much money.
I think I see where you're going. Look, I think in order to outperform the market, I'd rather be in the $500 million hedge fund. The problem is, it only takes a few quarters of very bad results and your anchor investor pulling your money out, and your 500 million hedge fund is 200 million, and suddenly your star analyst has left and your main trader moves on, and the next investor takes his money out, and suddenly you're fighting for your life, right? So the very thing that makes a small hedge fund nimble and able to outperform makes it also prone to huge survival risk. So, you know, if I'm a young analyst, it's a tough call. If you go with Oaktree, they're now going out of business, but are they really going to outperform the index, or they are the index in a way, right? So how could you outperform them? So I don't know. And thankfully, I don't have to answer.
I want to move a little to diversity and sexism in the industry, because next month is Women's Month, and we're going to actually on March 9th have a forum for Women's Month that I encourage everybody to look into and attend. But you write about that. That's the other theme that's present through the book, and it's an important thing to discuss. I want to start with the title, because I love the title, Damsel in Distress, and play on the term damsel in distress. But you know, having read the book and having gotten to know you here, I don't think you fit that prototype, and I'm not sure that that'll be successful in the industry. Was that irony intentional?
Yes, Mark.
I'm gonna get to something you said, and I want you to elaborate on it. There it is. You say, "I deeply believe that I had to be more forceful, more aggressive, more persistent, more willing to put everything on the line than my male peers did." Talk a little bit about that. How, you know, what are the different standards that women are held to in the industry?
Look, it's hard to say. I did feel that way, that what I wanted and what the positions I wanted to put capital behind, I had to be very forceful, very aggressive about, and that it was more so than my male colleagues. That said, obviously I was in their shoes, and they might have thought differently, and they might have thought that my ideas were terrible. I don't think so, not systematic. At least they were not all terrible, because I made a career out of it. But I don't think it's very specific to my business. What's specific about my business is that there are very few women, so I was the only one having that experience. But I think, I mean, I'll ask the women in the audience. I think in a lot of business, we have to be more forceful and more demanding and more aggressive about being promoted, about getting a raise, about having capital. I think it goes for women, but not only. It probably goes for many minorities in a lot of business. That's sort of the unfortunate truth, is that if you're not the average, it's more difficult to obtain what you want, and it's less comfortable. How can it not be, right? Because I mean, I hate to say it, but the average hedge fund manager is a white guy, so it is more comfortable to argue in a room of people who look like you and think like you.
Well, you talk about active sexism and passive sexism. Can you unpack that a little for us?
That's important to me, because I think we've gone maybe a little, well, I don't want to say we've gone too far, but to me there's a difference between a comment that may be a little bit misplaced, but doesn't come from a bad intention. I think intention and intensity matter. So if somebody says something offensive once, it might just be a brain fart, and that's it. You can laugh it off, you can sort of move on. If the frequency, the intensity, the intention is clearly in the wrong place, it's somebody who says the meaning thing again and again with high intensity, the intention is clearly to deflate you, that's something that's very hard to mock or laugh. But to me, there is a difference. There is a difference when somebody says something. I think we all have said offensive things, and we can apologize for it, and that's okay. What's very difficult is the systematic sexism, and there's quite a bit of that in finance.
do you think things have gotten better in the past couple of years, after the Me Too movement, or do you think there's still a lot more needs to be done?
I think a lot more has to be done. A lot more has to be done simply because women and minorities are still sort of 3% of hedge fund management. So it's not going to get a lot better until and unless there's a much more balanced representation.
You've also talked about the benefits to hedge fund from diversity, and you've mentioned that women tend to be better managers on average than men. Can you talk a little bit about the factors that drive that and see those
I
studies?
wouldn't say they're better managers. There are studies, and it's not one, there are 3 or 4, that say that women are very good at pricing risk. In other words, risk is not a good thing on its own, right? Because otherwise, people who smoke, they take a lot of risks and they would be great managers. No, that's not what we mean. We mean taking the right risk for the reward. And in that respect, the studies show that women are very good at that because they tend to trade less. They tend to just change their mind and be active less. And so they actually save a lot of trading fees. There's less friction and their performance is better, noticeably better. Now, this study is mostly for retail investors, and also there's been studies of managers. But it's a pretty persistent and convincing research. So we're very good at pricing risk. That doesn't mean we're better managers, but we are at least as good managers as men. Aside from that, I think the research is overwhelming in demonstrating that decisions are better made with a diverse team, not only on the gender diversity, minority, social, economic class, etc. So even if you, I don't care about, if you didn't care about fairness and equity, you care about making money, you would make more money with a diverse team than a non-diverse team. And it sort of stands to reason that if you have 10 hedge funds whose investment team is 10 Harvard graduated male, they're probably gonna make the same decisions, right? And it'll be very hard to have a differentiated portfolio.
Right. It's funny because all managers say how they try to sell to their investors how they differentiate themselves.
Exactly.
One of the best ways to differentiate yourself is having
different people, right? I mean, they all say that we are providing alpha, except in their people, which are all the same.
Good lessons. Any other questions? Yes.
I do think that there is an additional factor when it comes to women in finance. It's they may be better managers in the area that they a little bit more focus on details and analysis. And in general, women in finance, they're expected to work harder to get to where they are. And I've done a lot of studies, and I'm a CFA member, and I run Alpha Women event. And it's always, I think that in private equity, there are 3% of women, and in hedge funds, I think it's over 10%, but still, it's not enough. And hopefully, it will change by 2030, hopefully. But it hasn't changed much in the past 10 years, unfortunately.
No, it hasn't. It hasn't. In the 20 years that I've worked for Canyon, I've met one other female partner.
Right.
So.
But, it's really in a lot of other areas. So, the diversity always adds value and broader perspective. And that's not just finance, it could be law, it could be so many other areas. But in law, I think there are more women and there are more women partners than in finance.
It's true.
Yes.
Just, light, but sort of little rebuttal on both female and the diversity side. I think nowadays you just have greater inclusion at the board level and and more so at the institutional investor level, where
There's a
on the
pressure.
other side of the table, that you're seeing and they're demanding to see counterparts, consultants, board members to be of diversity or gender. So I don't know that the 3% number, but I just have seen that there's a significant tailwind of progress in that area. Such that, let's talk about Texas and Florida and the BlackRock reduced allocation. Some of that is serious politics, it could be argued at the governor level and at the national level. But I'd be curious as to, if you felt BlackRock's response to that was sufficient. How would they properly address things like ESG, sticking to their mandates? I heard there was some structuring, but at the same time, they kind of stuck to this concept. What's your view?
I'm not sure how BlackRock responded actually.
It's really political, strictly political.
It's not
I
just
mean,
the investment world, look at Disney, how they changed completely.
Yeah, but there's one thing I want to say, which is I completely agree with you that there is change coming mostly from LPs pushing for more diversity. And I think it's a good thing. The next level would be actual insiders, so hedge fund managers believing in the value of that diversity to make more money. But I do see change coming. I see LPs putting pressure on managers to disclose and increase their diversity.
Anybody else? So with that, I want to thank you. This was
Thank you.
really fascinating. I enjoyed it
Thank you.
personally. And